This irks me so much. The biggest tax mistake really isn't what people think. People do make silly mistakes around their tax planning and missing opportunities to take advantage of tax rules. But the biggest mistake that people make is listen to their accountant's advice around how much income they take out of the business. Now, the analogy I like to use is that when you're a hammer, everything looks like a nail. And for most accountants, their hammer nail equivalent is that all they worry about is paying less tax. Now, the simplest way for the accountant to prove to you that they've been able to save you tax is for you to take less money out of your business. Because the less money you take out of your business, surprise, the less tax that you're going to pay, right? But the harsh reality of that is it results in a couple of things. One, it results in business owners not being able to build wealth outside of their business. Because if you want to get a mortgage, to buy your home, to buy an investment property, to build wealth, the banks need to see income. Well, they don't lend to people that don't make any money, right? So we see so many business owners capping what we call their debt ceiling, their maximum borrowing capacity, because of the insignificant amounts of money that they're drawing as income from their business. So that's the first biggest issue. The second biggest issue is that people need to eat, right? So if your accountant tells you to pay yourself 30 grand and your living expenses are 200 grand, the reality is that you're borrowing money from your company. And the company's money is not your money. And what happens is that there is this thing called a Division 7A loan or a related party loan. What it essentially means is that you've taken money out of the business, and usually at the end of the financial year, the conversation goes something like this. Like, Mr. and Mrs. Client, you've taken this 200 grand out of the business. You either pay it back, well, I can't pay it back, I've spent it. Okay, well, we can distribute it as a dividend and you're gonna have to pay 25% tax plus some top-up tax. Oh no, I don't want to do that. Okay, well, we can put it on this Division 7A loan thing and essentially we'll deal with it over the next 7 years. Oh yeah, let's do that. But what the accountant doesn't tell you is that you're now paying 8% interest. You now have to pay it back to the company principal and interest over the next 7 years. That interest is not tax deductible because you haven't used it for investment purposes. And the principal that you repay each year must be paid out as a dividend in the year that it's repaid. So what it does is it creates a compounding tax issue. And what we see is so many business owners come to us who've been doing these Division 7A loans for 3, 5, 7, 10 years. It's turned into hundreds of thousands, if not millions of dollars. They're getting these huge tax bills every single year that they can't do anything about because of all of these principal repayments, and they have absolutely no idea why. And then we tell them about this strategy, and I use strategy loosely, of what the consequences of Division 7A are, and they go, wow, why didn't my accountant tell me this? Well, 2 reasons. Your accountant is trying to make themselves look good to show that you're not paying any tax now. And 2, your accountant's gutless because they're not prepared to have hard conversations with you around how you should be taking money out of your business.